For a moment, set aside the noise of the present, the headlines, the markets, the daily urgency engineered to keep your attention fragmented. Instead, consider a single figure, calmly, precisely, without emotion, 317 trillion. That is the total sum of global debt. Not merely public obligations, but everything combined. Sovereign debt, corporate liabilities, household borrowing, financial leverage layered upon leverage. 317 trillion units of obligation. Now pause again, because this number does not merely describe scale, it describes imbalance. That figure represents more than 3 times the total productive output of the world economy. Every service rendered, every good produced, every hour of human effort across the entire planet. Even if the world ceased consumption entirely, if nothing were spent, nothing enjoyed, nothing wasted, it would still take several years of uninterrupted global labor to extinguish what is owed. And here arises the question that is curiously absent from polite conversation. If everyone owes, who, precisely, is owed? Debt is never abstract. It is relational. For every liability, there exists a corresponding claim. For every promise to pay, there exists an expectation to receive. And when one follows that relationship, not emotionally, not ideologically, but structurally, something uncomfortable becomes apparent. This is not a temporary distortion. It is not an unfortunate accumulation, and it is certainly not an accident. It is a system, coherent, persistent, and exquisitely effective. To understand it, we must begin by unlearning something deceptively simple. Most people imagine debt through the lens of personal experience. A loan, a lender, a borrower. Money transferred from one party to another, to be returned with interest. That model feels intuitive because it mirrors daily life. But it bears little resemblance to how debt operates at the level that governs nations, markets, and history. When modern states borrow, money is not taken from a finite pool. It is created. When government bonds are issued, they are purchased by financial institutions and central banks. And in the very act of purchase, new money comes into existence. Digits appear on balance sheets. Reserves expand. Assets and liabilities are born simultaneously. This is not a metaphor. It is the operational reality of contemporary finance. And here lies the detail upon which the entire system turns. Only the principle is created. The interest is not. If 1 trillion is borrowed at interest, 1 trillion enters circulation. But the obligation is greater than 1 trillion. It always is. The excess, the interest, must be extracted from future production, future borrowing, or future promises. Which means that by design, total debt must always exceed total money. The system does not merely tolerate expansion. It depends upon it. This is not a flaw discovered too late. It is the foundational logic. Now widen the lens. Global debt stands at more than 300% of global output. In developed economies, public debt levels once associated with total war have become normalized during peacetime. Corporations operate on leverage. Households are entangled in long-term obligations. Governments refinance perpetually. And yet, remarkably, the system continues to function. Markets open, payments clear. Confidence endures. Why? Because the system rests upon an assumption so deeply embedded it is rarely articulated, that tomorrow will be larger than today, that growth will persist, that productivity will outrun compounding obligations, that the future will quietly absorb the excesses of the present. But growth is not infinite. Demographics age. Efficiency gains diminish. Energy constraints tighten. Meanwhile, debt compounds relentlessly, and exponential curves eventually overwhelm linear ones. This is not speculation. It is arithmetic. So once again, we return to the question. If the world owes 317 trillion, who holds the claims? The answer is neither simple nor evenly distributed. Ownership concentrates. Power coagulates. And it does so through channels so institutionalized they appear natural. Let us examine them calmly. The first category is central banks, institutions tasked with stability, liquidity, and confidence. Collectively, they hold vast quantities of sovereign debt. In some economies, they own a majority of outstanding government bonds. These entities are often described as public servants, neutral guardians of monetary order. Yet their origins tell a more complex story. The earliest central banks were not created to serve populations. They were created to finance states. The prototype emerged centuries ago when governments sought funding beyond taxation. Private capital was enlisted. Privileges were granted. Debt became permanent. Over time, structures evolved, mandates expanded, and independence was formalized. But the underlying relationship remained. Central banks exist to ensure that states can borrow continuously and that creditors are paid. The second category is institutional capital, pension funds, insurance pools, asset managers. They hold the majority of financial assets globally. In theory, they represent millions. In practice, control is concentrated among a narrow managerial elite. Decision-making power rests far above the individuals whose savings are deployed. This is not scandalous. It is organizational reality, and it produces a remarkable effect. Debt finances growth. Growth generates returns. Returns are reinvested into debt. A closed loop emerges. Stability for institutions. Precarity for individuals. The third category is sovereign accumulation. States holding the debt of other states. A byproduct of trade imbalances and reserve systems, currency flows outward. Obligations flow back. This arrangement binds nations together through dependency rather than trust. And finally, there exists a quieter category: private wealth, dynastic capital, family offices, long horizon ownership. At sufficient scale, wealth seeks preservation, not productivity. The safest instruments are claims on governments, risk-free in name, politically protected in practice. Interest becomes inheritance, and inheritance becomes structure. When these layers are assembled, the picture sharpens. Debt does not belong to everyone. It belongs disproportionately to those least exposed to its consequences. Interest flows upward, risk flows downward, and the system persists because it distributes pain diffusely while concentrating benefit precisely. This is not injustice. It is architecture, and architecture, once established, resists alteration. Understanding this does not require outrage. It requires clarity. Because the question is not whether this system is moral. The question is whether it is stable, and history offers a sobering answer. No system built on perpetual expansion survives indefinitely. It adapts, it restructures, or it fails. The only uncertainty lies in how and who absorbs the cost. That is where our inquiry must now turn. At this point, a reasonable mind raises an obvious objection. If this system is so imbalanced, if it rests upon arithmetic that cannot ultimately resolve, why does it persist? Why has it not already fractured under the weight of its own contradictions? Why do markets continue to function, obligations continue to be honored, and the appearance of order remain largely intact? The answer lies not in sustainability, but in adaptability. This system does not seek resolution. It seeks continuation. And it achieves this by shifting burdens through time, obscuring causality, and distributing discomfort in ways that rarely provoke immediate resistance. To understand how, we must examine the role of interest more carefully. Interest is commonly described as the cost of borrowing. A price, a neutral exchange. But in truth, interest is something far more consequential. It is a claim upon the future. When an obligation carries interest, it asserts that tomorrow's labor, tomorrow's production, tomorrow's surplus has already been partially spoken for. Debt, therefore, is not merely financial. It is temporal. It binds the future to the past. And the further forward that obligation is projected, the easier it becomes to justify. Long maturities soften perception. 30 years, 50 years. Perpetual instruments. The burden dissolves into abstraction. Responsibility becomes collective. Accountability becomes diffuse. This is why debt rarely feels urgent until suddenly it does. History offers no shortage of precedents. Whenever obligations outgrow the productive base that supports them, societies respond in remarkably consistent ways. They default openly, they inflate quietly, they restructure selectively. Sometimes they do all three, but the method chosen is never accidental. It reflects power. Inflation, in particular, deserves careful attention. It is often discussed as though it were a natural phenomenon, a byproduct of external shocks, supply disruptions, or excessive demand. Yet inflation is also an instrument. When money loses value, debts lose weight. Nominal obligations remain unchanged, but real burdens diminish. From the perspective of a heavily indebted state, this is extraordinarily convenient. No laws are broken. No contracts are explicitly violated. No single decision can be blamed. And yet, purchasing power erodes. Who bears the cost? Those who hold currency. Those who depend on fixed incomes. Those whose wealth exists primarily as wages rather than assets. Inflation is not indiscriminate. It is profoundly selective. Those who hold tangible assets, land, equities, businesses, are insulated. Often, they benefit. As prices rise, asset values adjust upward. Debt becomes easier to service. Balance sheets strengthen. Once again, the system reveals its bias. It does not punish leverage, it rewards it, and it does so quietly enough to maintain legitimacy. This is why periods of monetary expansion are so often accompanied by rising inequality. Not because individuals suddenly become more virtuous or more reckless, but because the structure itself channels advantage toward those already positioned to receive it. Now, consider the institutions responsible for managing this process. Central banks are frequently portrayed as neutral arbiters, dispassionate technicians guided by data and mandate. In many respects, they are. But neutrality does not equate to detachment. Central banks operate within the system they are tasked to preserve, and preservation, under conditions of extreme leverage, requires intervention. When markets falter, liquidity is provided. When confidence wavers, reassurance follows. And when failure threatens systemic actors, support is extended. This pattern is not ideological. It is functional. Allowing the system's core to collapse would destroy the very architecture upon which modern economies rest. And so, time and again, the response is the same: stability first, resolution later, if ever. Each intervention buys time. Each intervention expands balance sheets. Each intervention deepens dependency. And over time, what begins as emergency response becomes expectation. Markets adjust. Risk is repriced. Moral hazard quietly embeds itself into behavior. This is not a failure of character. It is a rational adaptation to predictable incentives. Nowhere is this more evident than in the global reserve system. The world's primary reserve currency occupies a unique position. It is demanded globally. It is held widely. It is trusted deeply. This creates extraordinary flexibility for its issuer. Persistent deficits can be sustained. Debt can be refinanced indefinitely. Obligations can be rolled forward without immediate consequence. But privilege creates obligation. When interest rates rise, the impact is not confined domestically. Capital flows reverse. Emerging markets strain. Debt denominated in reserve currency becomes more expensive to service. The entire global system reacts. This interdependence creates fragility. Decisions made in one financial center propagate worldwide. Once again, this is not conspiracy. It is consequence, and it reinforces a central theme. This system is not governed by morality. It is governed by incentives. Now consider how this dynamic shapes behavior at every level. When debt is abundant and cheap, it becomes normal. Borrowing replaces saving. Leverage replaces margin of safety. Short-term optimization replaces long-term resilience. Why invest patiently when returns can be accelerated? Why accept modest growth when debt amplifies outcomes? This logic permeates corporate strategy. It permeates public finance. It permeates household decisions, and it works until it doesn't. The difficulty lies in identifying the moment when accumulation becomes excess. Because systems rarely signal collapse in advance, they signal success. Asset prices rise, consumption expands, risk feels distant. The warning signs are subtle: slower growth, rising servicing costs, increasing reliance on intervention. These are not dramatic, they are technical, and technical signals are easy to ignore until they converge. Now we must confront an uncomfortable reality. This system does not require collapse to fulfill its function. It only requires participation. As long as obligations are serviced, the structure holds. As long as confidence persists, continuity is maintained. Collapse occurs only when belief dissolves. And belief, as history demonstrates, can endure long after logic would suggest otherwise. Which brings us to the deeper question. What is this system actually designed to do? It is tempting to view it as broken. But broken systems do not persist for centuries. They fail quickly. What we are observing is not malfunction. It is optimization. The system efficiently transfers surplus upward through interest. It socializes risk downward through inflation and taxation. It maintains legitimacy through complexity. And it survives crises by absorbing them into its architecture. Each disruption strengthens concentration. Each recovery narrows ownership. This is not incidental. It is emergent. And emergence is often mistaken for inevitability. But inevitability is a dangerous illusion, because history shows us that systems do change. Not when they are criticized, but when they can no longer reconcile their internal contradictions. We are approaching such a moment. Debt levels strain credibility. Growth struggles to compensate. Political consensus erodes. Options narrow. Yet none of this guarantees sudden collapse. More likely is a prolonged period of adjustment. Managed instability, rolling interventions, gradual erosion rather than dramatic failure. This is how complex systems unwind. Slowly enough to be denied, quickly enough to matter. In the next part, we will examine how such transitions have unfolded before, not in theory, but in lived history. Who adapted, who endured, and why those outcomes were never random. Because the future is not shaped by numbers alone. It is shaped by preparedness. And preparedness begins with understanding. To see where such systems ultimately lead, one must abandon the comfort of the present moment and adopt a longer view. Not years, not decades, centuries. Debt systems reveal their nature not in their rise, but in their resolution. And history, when observed without sentimentality, is remarkably consistent. Every society that elevated credit from a tool into a foundation eventually faced the same dilemma: how to reconcile obligations that outgrew the productive capacity required to honor them. The answers varied in form, but not in substance. Let us begin with an essential observation. Debt does not collapse societies. Misaligned incentives do. Debt merely exposes them. When obligations expand faster than trust, cohesion weakens. And when cohesion weakens, systems fracture along predictable lines. Consider early monetary civilizations. In ancient agrarian economies, debt crises were not abstract financial events. They were social emergencies. When farmers fell into unpayable obligation, land concentrated. When land concentrated, power followed. When power centralized excessively, stability eroded. The response was not moral outrage. It was pragmatic reset. Periodic cancellations of debt were enacted not out of generosity, but necessity. Without them, societies imploded. These resets were understood as maintenance, not rebellion. Now contrast that with modern financial civilization. Debt today is disembodied. It exists as entries in ledgers, claims layered upon claims, abstractions removed from physical production. This abstraction creates distance. Distance dulls urgency. Urgency delayed becomes crisis. The modern era offers no shortage of instructive moments. The early 20th century provides a particularly clear illustration. In the decades preceding the Great Global Contraction, credit expanded aggressively. Financial innovation flourished. Leverage multiplied returns. Optimism hardened into certainty. Economic life appeared sophisticated, controlled, modern, until the mechanism reversed. When confidence faltered, leverage became lethal. Obligations could not be met. Institutions failed. And here again, the pattern emerged. Those with exposure were destroyed. Those with reserves endured. Those with liquidity acquired. The crisis did not eliminate wealth. It redistributed it. Afterwards, reform followed. Regulation increased. Constraints were imposed. Memory was fresh. But memory fades, and constraint is always portrayed as inefficiency. The post-war monetary order attempted discipline. Currency anchors imposed limits. Debt growth was moderated. Expansion was tethered to reserves. For a time, this produced balance, but balance is politically inconvenient. Limits frustrate ambition, and ambition always finds language. Eventually, the constraints were removed. When money was severed from any external anchor, debt was liberated. What followed was not immediate excess, but gradual normalization. Borrowing became policy. Deficits became routine. Expansion became expectation. And expectation, once established, becomes entitlement. The crucial shift was psychological. Debt ceased to be perceived as obligation. It became infrastructure, a permanent feature of the landscape, something to be managed rather than resolved. From this point onward, every downturn was met with accommodation. Rates were lowered, liquidity was provided, balance sheets expanded. Each intervention appeared rational. Each intervention worked, temporarily, but each also embedded a deeper dependency. Risk was displaced, not removed. Responsibility diluted. The system grew larger, more complex, more fragile. Then came the modern era of systemic rescue. When financial networks threatened to unravel, extraordinary measures were taken. Public resources were deployed to stabilize private institutions. Markets recovered. Confidence returned. But the underlying architecture remained unchanged. In fact, it was reinforced. Debt did not shrink. It migrated from households to states, from balance sheets to central banks. This migration is rarely acknowledged openly, yet it is the defining feature of contemporary finance. Crises no longer destroy debt. They consolidate it, and consolidation alters power dynamics. Ownership becomes concentrated. Decision-making narrows. Influence hardens. This is not conspiracy. It is consolidation. Now consider the role of interest rates within this evolving structure. For decades, rates declined. This created the illusion of sustainability. Lower servicing costs masked higher principal. Debt expanded without immediate pain. Asset prices rose. Confidence deepened. But low rates do not eliminate risk. They defer it. Eventually, pressures accumulate. Inflation emerges. Rates must rise. And when they do, the accumulated weight of leverage becomes visible. Suddenly, what appeared stable reveals its brittleness. Governments struggle to refinance. Corporations face solvency concerns. Households confront constraint. This is the moment when choices narrow. And historically, when choices narrow, those with power choose continuity over fairness. This is where inflation re-enters the narrative, not as accident, but as instrument. Inflation dissolves obligation quietly. It requires no explicit default, no public reckoning. It merely redistributes loss through diminished purchasing power. Once again, those closest to assets adapt. Those dependent on income adjust downward. The pattern repeats. At this point, one might ask, why is debt never truly resolved? Because resolution threatens claims, and claims represent power. Debt forgiveness destabilizes balance sheets. Balance sheets underpin institutions. Institutions underpin order. And order is rarely sacrificed voluntarily. Thus, modern systems choose complexity over clarity. They roll forward obligations. They extend maturities. They obscure causality. This does not eliminate risk. It transforms it. Risk becomes systemic rather than individual, diffuse rather than concentrated. Invisible until it isn't. And this is where psychology becomes decisive. Systems persist not because they are logical, but because they are believed. Belief sustains markets. Belief stabilizes currency. Belief postpones reckoning. As long as confidence holds, imbalance can endure. But belief is fragile. It fractures suddenly. And when it does, adjustment accelerates. History shows us that such moments do not produce equality. They produce sorting. Those with flexibility adapt.
Those without absorb loss.
And this outcome is not determined by virtue. It is determined by position, by proximity to capital, by access to optionality. This is why the most dangerous misunderstanding is to view financial systems as neutral. They are not. They reward certain behaviors, they penalize others. They privilege scale, access, and patience. Understanding this does not require cynicism. It requires sobriety, because the present moment carries familiar signals. Debt at unprecedented levels, growth under strain, policy tools stretched thin. The surface remains calm. The structure grows tense. This is how transitions begin, not with collapse, but with quiet imbalance. In the final part, we will step away from history and return to the individual. What awareness looks like inside such a system. What adaptation means without illusion. And why understanding the structure is not about escaping it, but about navigating it with intelligence and dignity. And so we arrive at the only place where this discussion can meaningfully conclude. Not with prediction, not with alarm, but with understanding. Because systems of this magnitude do not announce their turning points in advance. They drift. They adapt. They quietly reshape the conditions under which individuals live, decide, and imagine their futures. The question, therefore, is not what will happen. It is how one lives intelligently within what already is. Debt, at this stage, is no longer a temporary instrument. It is the organizing principle of modern economic life. It determines which risks are rewarded, which behaviors are tolerated, which failures are forgiven, and most importantly, which are not. When debt saturates a society, freedom becomes conditional, not abolished. Conditioned. Opportunity narrows not through prohibition, but through obligation. Choices remain, but their costs rise. This is how control operates in mature systems. Not through force, through structure. Now consider what this means at the human scale. Individuals enter adult life already encumbered. Education financed by obligation. Shelter secured through long-duration claims. Security traded for permanence. None of this feels oppressive in isolation. Taken together, it forms a quiet constraint. People adapt. They become cautious. They favor stability over exploration. They accept arrangements they might otherwise challenge. This is not weakness. It is rational behavior within a leveraged environment. And rational behavior, when aggregated, becomes cultural norm. This is how systems perpetuate themselves. Now let us address an uncomfortable truth. There is no moment of collective awakening, no universal reset, no elegant resolution. Those narratives belong to fiction. Real systems change through uneven adjustment, through gradual erosion, through moments of stress that expose fault lines. And when those moments arrive, outcomes are never evenly distributed. Those with assets adapt. Those with flexibility reposition. Those without margin absorb shock. This is not cruelty. It is mechanics. History does not punish ignorance. It simply rewards preparedness. Which brings us to the question of awareness. Understanding the structure of debt is not about fear. Fear clouds judgment. Understanding is about orientation. It allows one to distinguish signal from noise, to recognize when calm is manufactured rather than earned, to see that stability can coexist with fragility for longer than seems reasonable, and to act accordingly. Acting accordingly does not require radicalism. It requires restraint. It requires patience. It requires the humility to accept that no individual controls the system, but that individuals can choose how they relate to it. This is where many misunderstand the point. The purpose of understanding is not escape. Escape is fantasy. The purpose is navigation. Navigation means aligning one's expectations with reality. It means recognizing that promises embedded in systems are not guarantees, that growth assumptions are contingent, that incentives shape outcomes more reliably than ideals. When one sees this clearly, something subtle changes. One stops confusing volatility with chaos. One stops mistaking intervention for resolution. One begins to value resilience over optimization. This shift is not dramatic, it is internal. But it is profound because it restores agency. Agency not in the sense of control, but in the sense of choice. Choice grounded in awareness rather than hope. Now let us return, one final time, to the question with which we began. If everyone owes, who is the lender? The answer is not a person. It is not an institution. It is a structure of claims, incentives, and expectations layered over time. A system in which obligations flow upward while risk flows downward. A system that converts future effort into present stability. A system that persists not because it is just, but because it is effective. This does not make it evil. It makes it human. Human systems always reflect trade-offs. They privilege some values over others. They solve certain problems while creating new ones. The modern debt system solved the problem of growth. It now faces the problem of consequence. And consequence is never abstract. It arrives through lived experience, through purchasing power, through opportunity, through constraint. Understanding this does not require despair. It requires maturity. The kind of maturity that recognizes that no era is permanent, no arrangement eternal, and no system beyond adaptation. What comes next will not look like collapse. It will look like adjustment. Gradual, uneven, contested. And those who navigate it best will not be those who predict outcomes most loudly, but those who understand structures most clearly. If you have followed this analysis to its end, it suggests something about you. You are not satisfied with surface explanations. You are not comforted by slogans. You prefer clarity to reassurance. That matters, because cultures do not shift through outrage. They shift through quiet changes in what thoughtful people take seriously. If this perspective has sharpened your understanding, even slightly, then there is value in extending the conversation. Not to persuade, but to think together. A subscription is not an act of loyalty. It is an indication that depth still matters. A simple gesture that signals space should exist for long-form reasoning in an age of acceleration. A considered response, a comment shaped by reflection rather than impulse, contributes more than volume ever could. And if there is one person in your life with whom you enjoy thoughtful disagreement, nuanced conversation, and intellectual honesty, this is precisely the kind of material worth sharing. Not as conclusion, but as beginning. Because understanding systems is not about certainty. It is about discernment. And discernment, quietly cultivated, remains one of the few advantages no system can fully absorb. Thank you for taking the time to think carefully. That, in itself, is already a form of independence.